some key assumptions of technical analysis. Okay, some key assumptions. Number one, it all is a game of demand versus supply. Okay, if demand is high, supply is less, fundamentals, no one is going to check. Okay, and you need to make full advantage of that. Those of you who have made money in the stock market in the last 1 year, you have made money because of fundamental analysis. But there were a lot of people who exited the stocks by 12,000, 13,000 Nifty. Why? Because they felt that things are overpriced. But they did not realize that the liquidity, the money is still coming in the markets. No one stopped their SIPs. Yes, demand and supply zone analysis. It's called zone analysis. Okay, all right. There is a study called demand and supply zone analysis, where we draw the demand zones and the supply zones. These are demand and supply zone. And there is something called boring candle, explosive candles. These are all covered in advanced courses, okay, which is called zone analysis. So demand and supply is triggered by liquidity. Now in India, in the stock markets, retail investors have put in huge money over the last 1 year. It's not the FII, it's not the DIIs who have pushed the stock markets up. It is the retail investors which have pushed the stock markets up. And this has happened first time in 35 to 40 years that a rally, a bull run happened because of retail investors' participation. So liquidity has triggered that, and that demand and supply is way above valuation. I know all the stocks are overvalued right now. Fundamentally, if you ask me, I'm a CA. I cannot deny the fact that the stocks, mostly all the stocks are overpriced. And remember one thing, Nifty or Sensex, it is basically a barometer of 30, 40, 50 stocks, which means it is not the benchmark of the economy. I mean, how many of you here believe that our economy is not at all in sync with what the market is showing? Is there anyone who believes this? That our Indian economy, our situation, unemployment, inflation, the lowering interest rates, and every other common factor for growth in a country is being ignored by the stock markets. I think many of you would believe this, or many of you would like to accept this, or many of you are already believing it, right? So why isn't the stock markets reflecting the state of affairs of our economy? Many people, many knowledgeable people are saying that our Indian economy is literally on ventilators. I mean, either print some notes or do something. Our government is in that state of affair where it's not able to give income tax refund because it does not have money. It's not able to give GST compensation to the state bank governments because it does not have money. They are processing income tax returns with delays because they don't have the money to give the refund. Such is the condition of our economy, but the markets are at all-time high. Why? Because the stock markets, my dear, is not a reflection of the economy of our country truly. It is a reflection of the corporate India. Corporate India is basically the top 20, 30, 40 companies of our country. They have done tremendously good business during the pandemic because people went for online shopping. So the sales never dropped, in fact increased. Okay. And sitting at home, you have nothing to do under lockdown. At least you order good things, you order food, you order FMCG products, and then medical costs, etc. went up because of the pandemic, the pharmaceutical sector, etc. So all of these top 30, 40 companies, if you see, mostly they were all what? They were all either FMCG companies or pharma companies or related to those type of companies which went up during the pandemic. So it's only the corporate India, and most of the, I'll tell you, the top 20 companies of our country have shown around 20 to 25% sales and profit growth in the last 1 year. And that is why markets have doubled. So you cannot say that the markets are double, that it's a wrong thing. No, the markets and the market index are actually not reflecting the same things. Market comprises of all the stocks, and that should reflect the economy, and which is not being done. The economy is being represented with a market index in a wrong way. And the market index is at all-time high because it is correct, because the top 20 companies, they are having tremendously good profit. So it's not bad. The market index is showing what the corporate India is doing. Corporate India is rejoicing because number one, interest rates have gone down. So money is available, liquidity is available, loans are available from bank at 6% these days to corporate India. So sideways, uptrend and downtrend, these are the three different types of trends market will at any point of time will be. You have to first spot the present trend, whether it is an uptrend, downtrend or sideways. Basis that, we are going to see that when the last time the markets were at these level or these type of trend, what happened, which means history or trends repeat itself. Because if you don't believe in these assumptions, you will never be able to learn technical analysis. Okay, history or trends, they repeat themselves. So if in the past it had happened that, let's say, the stock had gone up like this and then it crashed from there and then it went up again like this. Now, as per the history, it feels as if that at this point here, because the stock is right at this point, it may face some resistance and it can actually go down from here, because history generally repeats itself. So you'll be cautious. But if it happens that the stock breaks out from this point here and it goes up, which is called a breakout, as I've already mentioned, then it means that now there is a new channel. But then if the stock does not break out and actually eventually comes down, we know that from this point, the stock is also due to go up. So this becomes actually the resistance and this becomes the support, as you all know, right? History repeats itself. If a stock has seen some demand at these prices 6 months before, right now when the stock is once again in the same price zone, then many people who missed out the bus last time, even the long-term investors who were thinking that once the stock goes down, let's say below 60 rupees, then I will buy it. So from 100, it crashed down to 60 and people started accumulating it and it went up. Now it's around 70s. So you know that when it is going to go to 60 back, a lot of people who could not buy the stock at 60 last time will buy it. So there will naturally be a buying interest and the stock will actually start going up. History repeats itself. So basically the three main things are that prices discount everything, prices moves in trends, and history repeats itself. It's a very important thing to know that history or past trend, they repeat themselves. Okay, and you should always know this. Please remember that whenever we follow these assumptions, believe in these assumptions, we will be only then be able to make money in the markets. Remember that patterns in charts, they are also repeated and patterns exist, which means if there is a stock which is doing like this, we generally say it's a flag pattern, if you can see, and from here the stock will actually go up. And I can show this on Nifty live to you that this actually happened, but we are having classes for that. We are going to do all of that. So finally, in the theoretical concepts of technical analysis, it is clear that because technical analysis does not use any data which is classified or it's not available, unlike fundamental analysis, it is a favorite of all the retail investors or traders, because all investors are equal. At least as far as the data is concerned, there is no filtering that I cannot access the technical data, but you can. Each one of us can access the same data. So it's easier to understand and easier to implement. Even a person who has studied till, let's say, class 8 or 10 also, but he has some basic knowledge of mathematics and has a good vision to look at the charts, is a person who can learn, can actually make big money in the technical analysis world. Because markets are driven by psychology, more by psychology. So it is clear that the psychological component has to be tapped in to make money. Technical analysts can make more money in the short run than fundamental analysts because they know where the psychology of the investors exists, right? Okay, so that's one of the biggest advantage. And then there is something called stop loss. So whenever we buy a stock, we always keep a stop loss and we always have a price target. All of these are features given by technical analysis. Stop loss, price target generally are not things of long-term investors. Long-term investors, they keep the stock for 10, 15, 20 years. They don't maintain stop losses, but stop losses helps you from magnifying your losses, and it enforces a discipline in your trading, which is very good. And then again, last but not the least, again, one important thing, whatever you learn in technical analysis is applicable in all markets, which means it is applicable in commodities, it is applicable in derivatives, it is applicable in currency, any market, even in Bitcoins, cryptocurrency, it is applicable everywhere. Whatever you read or study in technical analysis of one market is applicable in other market, also in applicable in all markets whatsoever, infinite. It's not like fundamental analysis that if you have learned about crypto, you cannot apply it on commodities. If you learned about commodities, you cannot apply it in currency. It's not like that. Okay.